Finding the next 10x is already very, very difficult. Even if you think you found the right one, you still have to hold through a long period of time to reach a 10x return. Throughout all those years, the stock can go up 50%, 100%, and crash 60%. So it's a long, long way from the moment you buy until you actually get a 10x return. Unless, of course, you buy quantum computing stocks, then you're up quite quickly, right? Anyways, in this video, I want to touch on a completely forgotten company for good reasons, because financially they were underperforming. But in more recent quarters, the company is showing some good signs of growth. Their projections for the next couple of years are quite ambitious, but if they achieve it, I think today's price is a bargain, despite the competition and despite the noise around the company and the industry that they're playing in. Now, what company am I talking about? I'm sure some of you have already maybe skipped this part. The company I want to touch on is Lyft. Yes, I've been talking about Uber for a long period of time, and Uber stock is down because of, well, the fears that automotive vehicles will completely destroy its business. So why am I even talking about Lyft, right? It's the number 2 player. So it's not even the number 1. If you want to go with the number 1, right? I can agree, and I will explain all of it in this video. I want to touch on Lyft. Lyft right now has a market cap of $5.9 billion and a forward PE of 14.1 times. Year over year, the stock is up 3%. Now, of course, if we zoom out a little bit and we look at the 5-year return, the 5-year return is completely, well, it's horrible. It's horrible. It's down 67.37%. As you will see, there might be a comeback in the making. And since it's only at $5.9 billion in market cap compared to Uber, which is at what, $130 billion, of course, the scale of those businesses are completely different, right? Lyft is United States and Canada as of right now, might expand more in the future. And Uber is, well, in 70 countries around the globe. So yeah, it does make sense that one is much bigger than the other. But I'll explain all of that in this video. If you're interested to hear more, sit back, relax, hit all the buttons. 2025 is the year we're going to try and reach, well, not try, we are going to reach 100,000 subscribers in 2025. So hit that subscribe button, it's free, you can always unsubscribe later. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Lyft right now, if we look at what the analysts are expecting this company to do, we can see that growth, especially the bottom line, so profitability-wise, it's expected to grow quite quickly and much quicker than sales growth. Then looking at the average analyst price target, that sits 37% higher than the price we're at today. And you can see a huge increase in average analyst price target that happened after the last earnings report. Now, what you can also see, and this is something you are going to see later in the video, is that, well, all the gains from that earnings pump completely disappeared. Looking at some pricing metrics here, forward PE 14.1 times, lower than the now 4-year mean. EV to EBITDA is also much lower, price to sales under 1, so yeah, quite cheap there. Price to free cash flow, that's in the last 12 months, that sits at 9.2 times. Now price earnings to growth 2.69, but yeah, there is still a missing piece here. Now, I first want to touch on this. You've probably seen yesterday a couple of folks talking about, well, Amazon, there was a rumor Amazon might buy Lyft. But in reality, the truth here is there's no rumor. This is a prediction by this person right here, predictions 2025, Amazon will buy Lyft. This is a prediction, not a rumor. And they said the following: the acquisition could provide Amazon with a platform for possible autonomy in transportation services, aligning with future tech trends. This move could make Amazon Zoox robotaxis an immediate competitor to other autonomous vehicle services like Waymo. Integrating Lyft could allow Amazon to offer a comprehensive mobility solution, potentially integrating with its logistics and delivery operations and some other stuff as well. To be honest, I just don't see Amazon spending close to $6 billion, probably even more, because they would probably have to buy it at a premium. So $6 billion, since they already have Zoox, I just don't see this happening. Now, with regards to free cash flow growth, so Last 12 months, free cash flow sits at $641.3 million for fiscal 24. The number here, from analyst perspective, is expected to be $625.5 million. Management told us that free cash flow will exceed $650 million. And then if we go back to what the analysts are expecting to happen in fiscal 25 and fiscal 2026, well, in fiscal 25, analysts are expecting free cash flow to drop by 5.7%, but then reaccelerate by 16.4% in fiscal 2026. Now, they're already wrong on that number right here for fiscal 24. If we are to believe what management told us, 650, so that's already close to $25 million difference. So who says that free cash flow is going to decrease in fiscal 2025? Zooming out a little bit and looking at the actual business, we can see that active riders have grown since the June quarter of 2021 at a compound annual growth rate of 11.46%. Number of rides have increased at a compound annual growth rate of close to 19% since the March 2022 quarter. And well, we've seen a nice reacceleration in growth actually in the March quarter of 2023. The revenue per active rider has gone up quite a lot since what it seems to be now the bottom here in the June quarter of 2023. Then looking at some margin metrics. So free cash flow margin has gone from negative to now positive 11.7%. Gross profit margin has been plateauing a little bit. Revenue continues to go up as we've seen, and net income is trending, well, net loss is trending to be net income. Quickly looking at what happened last quarter, revenue went up 28.2%, but total cost and expenses increased 31.86% with a big increase in sales and marketing and G&A. If you look at net loss, that increased by 2.69% and diluted earnings per share were up 5.89%. They also announced the following, that they are joining forces with Mobileye, May Mobility, and Nexar to connect riders to autonomous vehicles. So of course, they're not sleeping on the fact that yes, autonomous vehicles are going to be a thing. So here they are partnering up with Mobileye, they're partnering up with May Mobility and Nexar. Mobileye, we already talked about that, what they're trying to do. So Mobileye, a leader in self-driving tech and advancing driver assistance systems, or ADAS, plan to bring AVs to the Lyft network. Through this partnership, Lyft will make its scaled rideshare platform available to all vehicles with Mobileye's self-driving technology. Vehicles equipped with Mobileye drive technology will hit the road Lyft ready, giving small and large fleet operators seamless access to Lyft platform and network of riders to optimize their vehicles. Then with regards to the other two, May Mobility will directly deploy AVs to the Lyft platform in Atlanta starting 2025. I believe Uber and Waymo also have a partnership and something that will launch in Atlanta. So that's going to be interesting to see how they compete with each other. Then Nexar and Lyft will explore ways to harness the power of aggregated anonymized marketplace and fleet data to help OEMs and AV companies build better and safer autonomous technology. By pairing Lyft data with Nexar's hundreds of millions of hours of video footage, they can jointly contribute to a more complete data set for autonomous research and development. Now, of course, you might think, okay, that's cute and all, but once Tesla scales up, once Waymo scales up, it's over for the likes of Uber and Lyft. You know my opinion on that. I just don't see that happening. I think there is, and especially this has been seen more recently, especially New Year's, during huge events. When everybody's going out, nobody's taking their cars. You see the price surge, right? You see that demand is just so much bigger than supply. So you introduce autonomous vehicles. You have now more options, right? The demand will just increase. There will just be more and more demand. The supply will increase as well. More people will take rides. Now, you might say, okay, that's true, but they will take rides using the Tesla app. They will take rides using the Waymo app. While I agree that definitely some people will download extra apps, why not just put everything in Uber, the Uber platform, which already connects to millions and millions of people, or the Lyft platform? Just makes more sense, right? Because you get the distribution. I guess we'll wait and see. Anyways, we can now compare Lyft and Uber, free cash flow, total revenue, and free cash flow margin. Of course, revenue-wise, Uber much more, And actually, if we go and look at the growth comparisons, Uber growing at a compound annual growth rate that is faster than Lyft. But if we look at free cash flow margin, both of them are quite close one with each other. So that's quite interesting. Of course, free cash flow wise, Uber is already generating a couple of billions of dollars worth, Lyft starting off quite small. The last couple of things here are with regards to Lyft Media, the advertising side of things, and their 2027 goals that they mentioned in the Investor Day last year. They say that Lyft Media platform is a profitability catalyst. They expect 2027 Lyft Media gross bookings to be over $400 million by 2027. The penetration rate of advertising within Lyft's gross booking currently sits just under 2%, so there's definitely some growth potential ahead. In 2027, they expect the following: gross bookings of around $25 billion, adjusted EBITDA of around $1 billion, and free cash flow around $900 million. They expect to achieve GAAP profitability early in the 2025-2027 plan horizon. And remember, $650 million is the number for 2024. So the next chapter of profitable growth is this. In 2024, gross bookings will be over $16 billion. 2027 targets, they expect a 15% CAGR. Adjusted EBITDA right now is around 2.1%. By 2027, that should be around 4%. Free cash flow as a percentage of adjusted EBITDA is now a bit bigger than 70%. They expect it to be here in 2027 over 90%. So very, very ambitious goals. Now, if we do a quick reverse DCF here, we plug in the free cash flow trailing 12 months, terminal growth rate 4.54%. Yes, it's quite high because here in this case, I'm using what the Modern uses. So this is basically the explanation. And then a discount rate of 10.39%. And we can see that to justify today's price, they will have to grow free cash flow by 1% for the next 10 years, for each of those years, right? And this also includes a 4% dilution, which right now is quite high. I expect it to be a bit less in the next couple of years, but okay, let's use that. It's basically a pretty conservative scenario here, although you might say, oh, but this is quite high. Okay, 4% dilution, discount rate is higher than the usual because I'm adding here 2% execution risk. So yeah, I think the risk reward here does make sense. Of course, the question is, can it 10x? Can it go from $5.9 billion to $60 billion? I think it can if they execute correctly. If they do reach these 2027 target goals, I think they could be reaching $50-60 billion in due time, not by 2027, because even with those goals, still not good enough. But right now, only United States, Canada starting off pretty good. Maybe they'll expand even more. Remains to be seen. And as they expand in more and more countries, of course, the pie just becomes bigger and bigger. And then, yes, there is that risk of autonomy that might or might not destroy the business despite the recent partnerships. We've talked about that a lot with Uber already. Plus, there is the fact that Uber still exists and it's by far the biggest player there. So there is that. Looking at the stock right now, as you can see, this huge green candle here, that's basically the last earnings report. So that gap up has been completely filled. So we'll see. We're now sitting at the, closer to the 200-day moving average, a bit over it. The 50-day one sits at $14.80 and the 20-day one at $14.50. So overall, that's about it. What do you think? Do you think Lyft makes sense at these prices? Do you think it has a possibility to be a 10x? Let me know down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye-bye.